Everyone makes the same mistake with triangle patterns. They obsess over one question: is it going to break up or break down? But the traders who actually make money in the market don't worry about that. They're not trying to guess the direction at all. In fact, they can be wrong 6 times out of 10 and still come out ahead. Sounds strange, right? Stick with me to the end of this video, and you'll understand why guessing the direction isn't the point. We'll cover the 3 triangle patterns, and then I'll show you exactly how to trade them in the real world, starting simple and building up from there. Part 0. Let's clear up this misunderstanding first. There are 2 reasons people lose money on triangle patterns. First, they believe the direction is already decided. An ascending triangle always breaks up. A descending triangle always breaks down. That's what a lot of you have memorized. It's not true. An ascending triangle doesn't only go up. It collapses downward more often than you'd think. And a descending triangle can shoot up just as easily. The direction only has a slight lean to it. It's not a sure thing. It's more like a weighted coin. Second, they enter before the pattern is complete. They watch the triangle narrowing and think it's about to break out, and they buy somewhere in the middle. But this pattern might never finish. Sometimes it just fizzles out as it converges. Sometimes it breaks the opposite way. The moment you enter early, you're betting on your own expectation, not on the market. So every strategy I'm about to show you starts from one principle. Confirm first, then enter. Part 1. Triangle patterns. This is all you need to know. Let me quickly explain why triangle patterns form in the first place. A triangle is a zone where buying pressure and selling pressure clash in an ever tighter range. The swings up and down get smaller and smaller. It's like compressing a spring. Energy builds up. We call this convergence. Then, when price finally breaks one way, all that stored up energy releases in that direction. That's why a strong move usually follows a triangle breakout. Now let's run through the 3 shapes. An ascending triangle is flat on top. The resistance line is a straight horizontal line, while the lows keep rising. That's a sign buyers are getting stronger, so the odds lean slightly toward an upside break. A descending triangle is the opposite. The support line holds flat along the bottom, while the highs keep dropping. That means sellers are getting stronger, so the odds lean slightly toward a downside break. A symmetrical triangle has lower highs and higher lows, squeezing toward a single point. It's the most neutral shape. It doesn't lean either way. Finally, how to measure your target. This is the same for all 3. Measure the vertical height of the widest part of the triangle, the entrance where the pattern begins. Then take the point where price breaks out and project that same height in the breakout direction. That's your target. A tall entrance means a far target. A short entrance means a close one. One more thing, signals are more reliable on higher time frames. I'd recommend watching this on something like the 1-hour or 4-hour chart. Alright, let's get into the real trading. Strategy 1. Confirm the break before you enter. Ascending triangle. Let's start with the easiest one. I'll use the ascending triangle to explain. The resistance line up top is flat. The lows keep rising, and price is pressing right up against that resistance. Do not buy early here. It could fail to break through and just roll over. There's only one moment to enter. The moment price closes above the resistance line and that candle completes. That's when you go in. There's one more thing to check. Volume. On the candle that breaks resistance, volume needs to spike well above normal for it to be a real breakout. A breakout that slips through without volume often gets pulled right back inside. So always check that volume is backing it up. Set your stop in advance. Draw the rising trend line, connecting the lows. If price closes below that line, you cut the loss, no hesitation. Your target is what we just learned. If the triangle's entrance height is 3%, then 3% above the breakout point is your target. This is where a good setup separates itself. Say the distance from the breakout point to the trend line, your stop, is 1%. That means you risk 1% to make 3%. That's a 1 to 3 risk reward. A setup where you only need to be right one time out of 3 just to break even. And if price keeps climbing, you can take partial profit and let the rest ride the trend. The key here is entry timing. You enter a triangle not before it's complete, but the moment it breaks out. Strategy 2. Build the risk reward before you enter. Descending triangle. Now we step it up a level. This is about picking good setups by their risk reward. Let's look at the descending triangle. The support line holds flat along the bottom, while the highs keep dropping. The odds lean toward a break down through support. If you only trade spot, the moment support breaks is a place to step aside or clear out what you're holding. If you trade futures both ways, you can short here. Entry is the same idea. When price closes below the support line and the candle completes, you enter short. You don't go in early. Volume works a little differently here. An upside breakout needs volume to be trustworthy, but a breakdown often happens even without a volume spike. Markets can fall just under their own weight. Still, if it breaks with rising volume, treat that as an even stronger signal. Your stop goes at the nearest descending trend line, the line connecting the highs. If price closes above it, you cut. Your target is the entrance height projected downward. If the entrance is 4%, then 4% below the break is your target. Now here's the part that really matters. Even with the same pattern, where you enter completely changes your risk reward. Enter early in the convergence. While the triangle is still wide and your stop is far away, you might have to risk 3%. But enter near the tip of the triangle, where the two lines nearly meet, and your stop distance shrinks dramatically. 1% is enough. The target is the same, but the stop gets tighter. So the closer to the tip, the better your risk reward. That's why, the later the convergence gets, the better the setup becomes for a trader. A good setup is defined by its risk reward. Tight stop, far target. Only enter where that's possible. Strategy 3. Enter so you survive being wrong. Symmetrical triangle. Last one. The hardest level. This is about making money when you don't know the direction. Let's use the symmetrical triangle. Lower highs, higher lows, squeezing into a single point. You genuinely don't know whether this goes up or down, which is exactly why you must not enter early. You wait until the direction reveals itself. You enter in the direction of the break. Close above the top, you go long. Close below the bottom, you go short. When you don't know the direction, volume is a great hint. During convergence, volume usually dries up more and more. Then, the moment it breaks one way, if volume surges back to life, there's a high chance that direction is the real one. A break that isn't backed by volume could be fake, so don't rush in after it. Your stop. If price closes back across the opposite trend line, you admit you were wrong and get out. Your target is, again, the entrance height. Up to here, it's the same as before. Now for the real expert territory. 2 more things on top. First, you size your position to your stop distance. Where the stop distance is tight, say 1%, you put in your usual amount, let's say 10,000 USDT. But where the stop distance is wide, say 5%, you cannot put in that same amount. You cut it to 3,000 USDT. That way, even if you take the full 5% stop, it's only a 1.5% loss against your total account. The wider the stop distance, the smaller you size. Following this one rule dramatically reduces the chance of blowing up your account. Second, you don't treat this as a single bet. Even when you confirm before entering, you will fail sometimes. You see the breakout, you go in, and price gets pulled back in and stops you out. That happens a lot. But with a 1 to 3 risk reward, you can be wrong 6 times and still win, as long as you're right 4. 6 losses add up to 6, but 4 wins make 12. So don't put everything on one setup. spread across several that meet your conditions. Even if only a few work out, the math can still favor you overall. It's not a game of guessing the direction. It's a game of surviving being wrong. Let's wrap up the 3 strategies. Strategy 1 is about confirming the break before you enter. Don't buy early. Wait for price to close past resistance or support, check that volume confirms it, and then enter. Strategy 2 is about only picking setups with good risk-reward. Near the tip of the convergence, you keep your stop tight so your losses stay small and your wins stay big. Strategy 3 is about entering so you survive being wrong. You size your position to your stop distance, and instead of betting everything on one setup, you spread across several. All 3 share one thing in common. Triangle patterns aren't a game of guessing whether price goes up or down. They're a game of confirming first, entering where the risk-reward works, sizing your position, and surviving even when you're wrong. Stick to that principle, and the direction of any single pattern barely matters. For more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If this video helped you, please like and subscribe.